Okay, so we have finished our discussion on demand, and now we are moving on to supply. Alright, the law of supply says this: if all other things are equal, then the higher the price of a product or service, the more that suppliers will offer for sale. Now notice that this is in direct conflict with the law of demand, because as consumers we want the best deal, the lowest price, and as suppliers their main goal is to make the most profit. So as the price goes up, they want to sell more of their item. So again, the law of demand: if all things are equal, the higher the price of a product or service, the less that people or consumers are willing to buy. If we compare the law of supply with the law of demand, notice that the law of demand relates to demand when it comes to price. The law of supply relates supply to price. Again, by two different sources. Demand is consumers, supply is suppliers. So a change in quantity supplied means that sellers are supplying a different amount of the product due to price. So just like demand, when the price goes up, suppliers want to supply more. When it's based only on price, it is quantity supplied. A change in supply means there is some other factor, some underlying condition other than price that would cause a supplier to supply less or more of a product. So the law of supply again is based on the profit motive, because as a business owner, your number one goal is to make money. So as one price increases, the quantity supplied increases. As the price goes down, the quantity supplied goes down. Again, one way to show this type of relationship between price and quantity supplied is by examining a supply schedule. Just like a demand schedule, a supply schedule shows the quantities supplied of a product at various prices during a particular time period. And we use the supply curve just like we did the demand curve in order to or the schedule. We use the supply schedule to make a supply curve by simply connecting the points. Now, unlike a demand curve, the supply curve is going to slope upward, and it's going to show a positive relationship. So as the price goes up, so does supply. So again, here is a little bit of review. An upward slope shows a positive relationship. As one variable increases, the other also increases. A downward curve, such as a demand curve, shows a negative relationship. As one variable increases, the other decreases. Again, here is market supply, which is the total output of all of the individual companies within one market. Notice the diagram here that you have a graph where there is two supply schedules, and notice that you have a shift in the supply curve. So we had the old supply curve, which is represented by S, and then we have a second supply curve which is represented by S1. So if it shifts to the right, just like in demand, we have an increase in supply. If it shifts to the left, we have a decrease in supply. So suppliers are businesses, people who create products, and suppliers use the factors of production, the natural resources, labor, capital, which would be tools and technology, to produce a product or service. If any of these if there is a change in any of these, if they can't get the natural resources, if they can't get the labor that they need, if they cannot get the tools or technology, then supply is going to be affected. In Chapter 5, we have a new law, a law of variable proportions. And there's a lot of information and a chart in your book that you'll want to refer to when learning about this law. This states that in the short run, output or supply will change as one resource is varied, even though the other resources do not change. So it highlights the relationship between the input of a product resource and the supply of a good or service. Now, in this example, and this is from your book, the only thing that changes is the number of workers. Everything else stays the same. Let's say this was a factory. The machinery is the same. The building is the same. They haven't increased space. They haven't added any technology. The only thing that's changed is the number of workers. So look what happens when you add one worker. You get 7 total products, and the marginal product, which is the difference, is 7. So you're adding 7 new products. If you add a second worker, you are now going to be able to output 20 products, and notice that your marginal product, the difference is 13. So you've increased, by adding one worker, you've increased your production by 13 products. As we go through this, look at worker 5, which we are now making a total of 90 products, and the marginal product is 28, which is very significant. You're adding, by adding one person, you were able to add 28 products. But look what happens when we get to add 6 people. So at 6 people, our marginal product goes down. Now notice that the total product continues to go up, but we're increasing by less and less each time. Now, what happens when we get to that 11th worker is that we are now in the negative marginal product. In other words, we have too many people. Either we don't have enough space, we don't have enough equipment, we're in each other's ways. But now, even though we're producing products, we are producing them at a negative marginal product rate. So this would not be a good case scenario. So the law of variable proportions has 3 different stages. And if you look at what we just looked at, was a production schedule that shows how the quantity supplied changes as the number of workers increased. Notice the definition for marginal product. You should be able to look at the table and figure that out. The extra output, or the change in the total product, that's caused by adding one more worker to the number of workers. And remember, in this scenario and in this law, only one resource is changed, and in this example, the resource that is changed is the number of workers. Nothing else has changed. So here's a little bit more on the stages. Stage 1 is increasing returns. Everything's good. The company's return on investment, adding new workers, is good. Things are working well. Supply increases every time you add a worker. Then we have stage 2, and even though the total product continues to grow, it is growing by a smaller and smaller amount. This is known as the principle of diminishing returns. So the amount of output is still growing, but definitely not as significantly as it did in stage 1. And by the time we get to stage 3, things are really bad. We are showing a negative return here, and it's clear that by adding a new worker, we are less productive than we were. So this shows where you would not want to add new workers because your production is negative. Now, if we think about an example that we can apply, think about garden. If you are gardening and you are planting flowers, do you have to have water for your plants to grow? And of course the answer to that is yes. So as you're adding water, is there a point where you could actually add too much water? Could that cause damage to your plant? So if you waterlog the plant, even though water is necessary and water is something that your plant has to have to grow, there is a place where it's too much and the plant is going to die. Notice in this example, the only variable that was changed was water. Nothing else. The amount of sunshine wasn't changed. The soil wasn't changed. Nothing was changed except the amount of water. And eventually you get too much water, and that resource alone, too much of that resource, is going to affect your output. Why does supply rise and fall? Well, when we looked at demand, we looked at consumers and how they react to a price change. When we're looking at supply, we are looking at producers, suppliers. And what we're looking at here is there a change in the cost of producing a good or service? And if there is, whether it be through a drought, a climate change, whether it be through some type of a cold snap, whether it be through war, whether it be through taxation, if there is a change in the price of producing a product, then it is going to change the production cost. And again, as a review, we have a definition here for productivity that we will continue to talk about throughout economics. And again, as a supplier, your number one goal other than profit is to be as productive as possible. That's going to help your profit. So again, another example of how production costs can be affected is through the government. The government can raise taxes or they can lower taxes, and that would affect supply, because as taxes are raised or lower, production costs are affected by that. So we know that taxes are a required payment that businesses and individuals have to pay to our government. So it says if a tax goes up, the cost of producing a good or service is also likely to rise. What's going to happen to supply? Well, in that example, supply is going to decrease, because if the cost goes up to produce an item, what's going to happen to profit? Well, profit's going to go down. And in that event, a supplier is going to supply less of that product. Also, regulations can affect whether or not a supplier produces more of a product, because a regulation is a rule that directs a business or an industry, and usually those are made to protect consumers. So if let's say that a milk company, let's say the dairy industry in general, had to go by a rule of sterilization and it cost them more money, that in effect would cause their production costs to go up, and so they would lower the supply of that product due to production costs rising. Now, when we think about elasticity in supply, we're thinking about how quickly can a supplier respond to a price change. So if a supplier can respond pretty quickly in producing an item, then it would be an elastic supply. However, if a producer cannot respond quickly, then that would be inelastic. We'll talk about this and give some examples of this in class, of some products that would be elastic and some other products that would be inelastic. So again, elasticity is totally based on production capabilities. If a company can respond quickly, supply is considered elastic. If a company needs time to react, in other words, maybe their product takes a long time to make, then supply